Good morning, everybody. Welcome back to the Schwab Coaching Channel. It's the Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from Denver, Colorado. Big thanks to my friend Barb Armstrong, who is going to be in the chat here with us today. So take a moment and say hey to Barb in there. Of course, she'll get to questions and comments that I'm unable to get to with you all today. But it is a solo show for me here on Trader Talk. So of course, I'm going to try to bring your comments and questions into our discussion today. So please feel free to post in there for the duration of the show. Additionally, make sure you're following Barb and me on X. Barb's available, Barb Armstrong CS. Of course, I'm Kevin Horner CS there on X. We'd love to have your follow. We try to post for you some charts, some ideas, concepts. When I say ideas, largely we're talking about ideas for management of our own emotions. A great topic every day of the week, perhaps more so today than usual on the heels of yesterday afternoon's tariff announcement. So, of course, we've got plenty to get to with all of you today. So, we're going to work through as many of the headlines. We're going to level set on a lot of the areas of the market today. That just means a lot of individual charts, hopefully to get a bit of a better understanding of how the market's choosing to react to what we learned late yesterday, which seemed to be a little bit more aggressive in terms of the administration's process for these tariffs than maybe many investors and traders were hoping for, certainly maybe more aggressive than they were expecting. And that's what's led to this substantial selling that we had late overnight into this morning open. So let's get down to disclosures and then we'll start looking at some charts, okay? So first of all, remember, our conversation is exclusively informational and educational. We do not make recommendations nor endorsements for any particular approach or strategy to trading the market here. We also do talk technical analysis quite a bit, of course. Technical analysis is merely a piece of the puzzle, though. We do not encourage you to base your decisions exclusively off technicals. I do think that you need to incorporate a number of key components as you make your decisions. Additionally, today, I just want to call out options. Remember, options are not suitable for all investors. They do require prior approval before being able to trade them here at Schwab. And we request that you, or actually require that you request your option authority on each individual account where you would like to trade options. Now, bear in mind, you can have different approval levels on different accounts, so just keep that in mind as well. And if you have questions about the process there, you can always reach out. We've got someone available for you 24/7, 800-435-4000, or for our trade desk, 800-435-9050, 100% of the time, 24 hours a day, and 7 days a week. All right, so let's just briefly look at the agenda. As always, we're going to hit the major indices and then a lot more look at the sector charts, I think, today to really try to get a more comfortable understanding of how we're moving money around today. It's going to be a pretty interesting day. So let's get to that SPX, everybody, where we, of course, had a pretty weak open here. But as you can see, weak opens of late have been intraday, at least, short-term intraday buying opportunities. We have opened to a level that we've not visited since back in September. And, I've got a green line drawn in here right around that 5,400 level. And I did that because, I was kind of dubious about our ability to maintain 5,500. It is a round figure for us. And of course, we've noted many times here in this segment the opportunity to maintain or bounce at important areas. And certainly as it relates to the S&P 500, those round figures on the $100 levels tend to take some precedent over other alternate levels. So just keep that in mind. Now, that low that we have here at 54, you can see 5,400 has been tested a number of times. Could it be supportive for us? Absolutely. Does it mean we have to get there? No, but given the nature of the tariffs announcement yesterday, there's a lot of discussion about those being far more wide-ranging than maybe expected, inclusive of many, many more countries than may have been anticipated as well. And that's kind of led us to this pretty weak open here. Of course, for those of you that weren't maybe paying attention late yesterday, we got going in the selling in earnest yesterday afternoon, right during the the middle basically of the president's speech here. So let me just highlight for you just the expedience of the selling, everybody. We were moving a little bit higher there in the initial period. And then as we got to some clarity, this is when he actually showed the chart highlighting expectations for these tariffs. That's when things really worked off. So we moved really aggressively from 57, 60s all the way down to the very quick low that we have tested a couple of times already this morning. As you can see, that by itself was a 5% reversal, everybody. So the market and traders of the market using that announcement to really reprice the market, right? Trying to gain an understanding of what makes sense for the broad indices here and for individual equities. So everything at this point is in what I would describe as simply discovery mode, because we truly have still a whole lot of uncertainty as to what how this is all going to play out. So big move in the S&P 500. If we drill in to the 5-minute bars, we're going to talk briefly about the level that we gapped. We gapped the S2 ledge down here, as you can see. Interestingly, S3 was kind of hidden. It's at my 5,400 support line. I hope it's needless to say we do not want to visit that today, but certainly it's on the table for us, unfortunately. So we have to be aware. Now, for those of you who've been watching the Trader Talk for some time, you've heard me over the last couple of months here encourage an approach, not one to tell you that weakness was in the market or coming into the market rather, but one that encouraged investors and traders to just be comfortable with what they were doing, what they had on the table, the money they were devoting to the market at this point, because the uncertainty was substantial. And my hope is that you've all heeded that concept. I was not telling anybody that the market was going to make these significant moves, but rather that the opportunity, the potential for more significant moves was on the table. Volatility was elevated, uncertainty was elevated. These are recipes that can lead to big moves. And of course, if we are overinvested or uncomfortable with the amount of money on the table, inevitably that's when things get bad for us as traders. So always be thinking about this. My hope is that today's action was not really surprising. If it was surprising, let's work our way back in time to see where we could have made decisions along the way that may have made today's move to this point a little bit more manageable. So if you're feeling as though you are still too heavily invested, it's okay. Take a breath. Just try to be thoughtful about your process and try to make a decision that is not out of haste. That's about the best encouragement I can give you. Hasty decisions are tricky for us. We tend to allow emotions to drive those decisions in the moment. That's why we talk so much about trying to have an idea as to just how you want to handle these things. And just yesterday, I think it was that I said something along the lines of estimate your worst case scenario and then maybe take it lower by another 10%. Never think that the level that you think the market can fall to is the lowest that it can fall. It can always go deeper than you expect and commonly will, right? That's how we get true short-term bottoms, everybody. So be aware of that. And of course, when we're talking about a bottom, one of the things we're going to look for is, does the VIX give us some indications? So we're seeing a very elevated VIX today. Touch on that briefly. It has been up over 25 and pushed into 27. We looked at this on the daily chart. You can see we're elevated, but not up quite to that 30 level. Could be an opportunity to monitor potential short-term reversal today. One thing to keep in mind as it relates to the amount of movement negatively in the broad indices here, it is a weak open, bigger to the downside than many would have hoped, of course, but a lot of that was worked out on an overnight basis. So we'll have to see if there's any inkling of covering or opportunity to the upside. Don't allow the short-term moves intraday here to suck you in if we're talking about that first hour of the day. The first hour is always fairly tricky. So keeping an eye on the S&P 500, some levels, and maybe keeping an eye on the VIX. Can we get the VIX to just continue to push down a little bit? Can we get back under 25? That could be for at least a short-term trade opportunity on the long side today. that could be instructive for us. So maybe something to monitor there. Okay, quickly we'll peek on our NASDAQ 100. I've got some lines drawn in here. Let's eliminate them just so we can talk about the price levels that are a bit more pertinent for us. The level here, still kind of akin to what we've seen here in the S&P 500, right? The low here today, kept testing that low we made about a week ago, and now we're off of the low initially. Way too early in the morning to know anything. So hopefully we're going to get a little bit of a relief bounce in here, but inevitably the concern is that we can continue to push lower. And again, the repricing, if you will, of the overall technology space, heavily weighted technology in the NASDAQ 100, of course, definitely gives us a little bit of a pause here. So paying attention to this on an intraday basis, we'll take a look at the same thing we saw in the S&P, right? A gap below the S2 pivot level, 18,928. The first 15 minutes here, not capable of making any hay at all. So, just be aware, week open has not really provided much as of yet. But it is that first hour where we're going to want to see, can we get any kind of a foothold here? And I would just say that at least for this first 10 minutes, it certainly does not seem to be the case. Remember, what are we looking for as it relates to intraday action relative to these potential pivot point levels? They can provide us intraday opportunities of support or resistance. In this case, now that 18,931 is a short-term zone of resistance. If we break through it, right, on this 5-minute bar, what we want to see are basically three consecutive bars above and through that 18,930 area, holding that green line as new short-term support. That's ultimately what you'd like to see. That could give short-term bullish traders some intraday opportunities. But again, I would caution that today has a lot of uncertainty, and it might not be the day to be out there just playing around looking for trade opportunities unless you've been perhaps building a plan, knowing some levels you want to work with, and you're going to use today's action to take advantage of those opportunities. But, if you're showing up today and just looking around and saying, boy, there's a lot of volatility, there could be some trade opportunities, I would just caution just against taking too many opportunities in this case. I think it makes a lot more sense for many traders, especially if this is one of those moves that you've not previously participated in. Well, then it might be one to sit back and watch. Today could be a formulate ideas type of day and get some understanding of how the market likes to act on these instances, everybody. I think it's worth keeping an eye on, but that's not necessarily a day for trading for a lot of us, right? It could just be one of those watching days, right? You can learn a lot just by keeping an eye on the major markets, major indices here today. Okay, let's see. Lots of conversation in here, everybody. I'm glad to have you all. I see a ton of very familiar names as usual. Okay, so there's a quick look at our S&P 500, our NASDAQ 100. Let's check out the Russell 2000. Unfortunately, the tariff news really hammering the small caps here. A couple of reasons for that, of course. Anecdotally, I've been hearing from small business builders, small business companies who are sellers in the retail space. Many of them get parts and detail from overseas, of course. Many of those small businesses are going to see increase to cost, shrinkage of their margins. That's one of the reasons we're seeing this. Now, there is a potential green shoot as it relates to the small caps, but we're going to have to balance this all out, everybody, because obviously tariffs are going to weigh on small caps. But one development that's been favorable for small caps with this move, given the potential for things to become a little bit more negative on the economic front, is we've seen a drop in yields here on the 10-year. So the yields have fallen through major support, which is going to be a benefit to a few groups. You know which ones, everybody. Eventually, we'll likely see that the small caps gain a little lift from this selling. This will help those with the heavier debt loads. Additionally, this will help potentially to shift mortgages a little bit, right? Maybe we start to see home purchases kind of free up a little bit as rates come down. It may make some homes more affordable for potential buyers as they are now working at rates that are nearer 4, maybe 4.5%, 5% on the 30-year. I'm not sure where the 30-year necessarily resides, but let's just take a peek. I think I can get that here for you. Yeah, the 30-year right around 4.5. So I'm sure mortgage rates are going to be coming down a bit, but it is a shift like that that could have a pretty decent impact on things in the housing market, which is kind of intriguing because the housing market's been one that's kind of been stuck, right? There's been this back and forth, this push and pull between the two buyers and sellers wanting to get top dollar for their pricing or for their home, of course, and not being capable of doing so because yields have climbed. And unfortunately, buyers have been hamstrung by those rising yields. So yeah, this drop in rates could be short-term beneficial for us. But as you can see, when we're in the midst of pricing all of this out, there's still too much uncertainty as we get kind of work through this here. Honestly, Greg, I don't know the answer to why I'm required to put in the colon and the CGI there on the TNX. When I first started using the Thinkorswim desktop application, TNX was all I needed. But in order to get the yield, that's what's required of me. So I don't know the specific reason or what it means per se. But in order to get the proper yield, that's what's needed. So TNX colon CGI. So there's a brief look at your S&P, your NASDAQ 100, your Russell 2000. Again, I don't know that today is necessarily the day to be talking about true areas of potential support, but let's just kind of work our way back through that quickly, and I'll just put in some levels for us, some things to keep in mind. The 2000 ledge was a very important one for us on the Russell 2000. So let's keep an eye on whether we can get right back up above it. It doesn't look great at the moment, but there's a potential spot. Let's just snap another line at this level right around here, which is about 19, I'll call it 1925, everybody, approximately. So we've been there before. We've well below the 200-day, have a 50 crossing the 200 to the downside. So there's not a lot that looks fantastic on the chart as it relates to the Russell here at this moment. So, we're going to be looking for some bounces, but we may have a ways to go. Let's kind of do something similar there on the NASDAQ 100. Of course, we tried to get off that ledge there today. Let's do one other thing here for the two big boys for you all, the NASDAQ 100 and the S&P 500. I want to draw a Fibonacci retracement for us. We're going to go back to the October of 23 period. Now, that's not the ultimate bottom, I'll point out. It was 2022 where our market underwent a real solid pullback, 30+% down year. In 22, what this represents, if I add a little time to it, this was coming out of that down year and then rallying and with a pullback. And so that pullback to the 200-day moving average back in October of 23, if we use the Fibonacci's from that low and extend to the double top that we see here on the NDX, you can see that we've taken out that 38% retracement zone. And a lot of traders will be looking for that 50% ledge to act as potential support. And that comes into this zone right here. So I thought I'd put a line there, everybody, or in this case, a rectangle to give you something to eyeball. And that's basically, the 50% pullback of the entire upward move. And that would be, 18, let's just call it 18.1 to about 18.5, approximately 300 to 400 point range on the NDX, which is, a small range relative to the size of the NASDAQ 100 index here. Okay, so there you go on the NASDAQ. That gives you something to kind of eyeball potentially there. What about the S&P 500? It's going to be a little bit similar, so I'll draw the same move from the same window, basically that end of October. And then you can see here, everybody, we've got a supportive line at around 5,400. That's my green line. And then the 38% retracement down to about 5,360. The 50% retracement now coincides with that August 5-week open we got, everybody. So that one stands out to a lot of traders. There's your August 5 bottom, 50% retracement. Look at that number though, everyone. That's around 5,100. Not all that fantastic, right? So we, of course, would prefer not to see it, but remember, as stated yesterday, we need to put some numbers on the table that say, well, this is where I think it can go. Now, if I'm wrong and it gets worse, where could it go? And I feel like in this instance, always considering that things could be worse than you expect might be the right idea, at least to manage our own portfolio of risk, okay? Again, I'm not suggesting that you think worse than what you think to be the worst case, because I want to be negative by any stretch. What I want to do, though, is build in an understanding of the capabilities the market has for big moves. And hopefully what that does for us as traders and investors alike, it gives us a more appropriate amount of money at risk, right? If you think that the market can't do something, like it can't sell off X percent, and then it does, well, then suddenly you're feeling incredibly uneasy, right? Well, I didn't think this could happen, so I stuck with everything I've been doing all along, and that means you're likely overinvested. If you think that something big can occur, you are apt to be a little bit more defensive. And that's kind of the encouragement I want to give, because we're going to get some bounce at some point. The question just becomes, do we get only relief bounces into resistance, providing continuation of downtrend moves, or do we start to shift and reverse course? So chances in the short run are elevated that our weakness persists. And in order to be long side traders, you're going to have to probably go about things with smaller dollars devoted to those trades and a faster window for your trade opportunity. Take advantage of relief bounces, but look to be quick exits, because it sure seems as though our rallies are apt to be sold in the near term. Okay, so let's see what else we've got here, everybody. Okay. Yeah, 5,400 might be a spot. Noting, boy, wasn't that long ago that we were hearing about Berkshire Hathaway having moved substantially to a larger portion of cash than traditionally. And it seems as though they've, Berkshire and Mr. Buffett making a lot of decisions that are not shockingly smart, right? Decisions in advance of this move, and it certainly seems to have benefited them. Now let's look at what's going on outside of the broad indices. Well, actually, let's do one more for us. Let's look at the semis here. So the semis fell through that 61% retracement. We're not liking the look of this. We have to pay very close attention here, as the risk off move can absolutely continue to hound the semiconductors. We've made a new RSI low down below. Look at this, everybody, moving in towards truly oversold conditions. The reminder that I'll offer is that in this bearish sentiment, remember that oversold condition can persist a lot longer than we'd expect. One of the things to keep in mind is that we don't buy based on oversold conditions. Commonly, traders typically want to see some semblance of confirmation, but oversold is not a reason to be a buyer. Oversold can stay oversold a lot longer than expected. The signal that a relief buyer might be looking for is when that RSI is under the 30 level, and then through price action moving to the upside, comes back upward through the 30 level to the upside itself. So when the RSI is below 30 but comes back above 30 as prices rebound, that can be a potential short-term buying indicator that some traders might incorporate. But this is not ideal, because what we're getting out of the RSI is actually confirmatory in nature of the bearish sentiment we've been witnessing since, really since the last peak up here. You'll notice we made this price high, and this high here in the RSI didn't make it to the overbought conditions. It basically matched this high here, lower than the last ones we made back here, of course. And then we just seen a consistent lower highs with that RSI. So, again, RSI more often than not is a bit more confirmation piece that some traders will incorporate, but it's not necessarily going to be a leading indicator for you necessarily. So just keep that in mind as well. So what is moving on the long side today? Well, you could see it's staples. We can't say we're surprised by that, right? You know, we've seen staples outperforming. In fact, if I did a quick look at our market watch, let's go to our quotes here and let us put in the public S&P sectors and indices. Take a look here. I've got 21-day relative strength. Well, they thought these would be loaded already, but they're taking their sweet time. Let's see here. Let's customize and let's put in I got a year to date percent change. There we go. All right. So really, all right, leadership on the year-to-date basis now with staples. Look at that. Energy is getting beaten back today. Just yesterday, energy was the leader on a year-to-date basis, but now it is staples, followed by utilities, followed by healthcare, energy, and then real estate. Now, that real estate, that one could start to shift a little bit now as money, as we saw that move in yields, right? So we can absolutely take into account perhaps the idea that falling rates could be beneficial for that real estate sector. Remember, when we talk real estate as it relates to the real estate sector, it is not home builders, right? Home builders fall under discretionary. Real estate is going to be heavy in REITs, commercial real estate, along with apartment complex real estate and so on. So as yields fall, you might see a flight into, especially for those who are in the later stages of their investment lives, looking for yield, right? And if you're not getting the risk-free rate of return that you were once getting, which was recently as high as 5% on the treasuries, well, then maybe now you're going to see traders or investors a little bit more willing to take on some risk to look for an improved yield. So that's the balancing act we commonly see there across the board, right? Where weakness in the market from a growth standpoint leads us to relative outperformance by staples and utilities, real estate, healthcare. So defensive in nature here is one way to be thoughtful about it. Okay, so big moves there. Let's look at some of these charts though. So here we have staples looking to try and bust out of the range it's been in. We got thrown back here over the last month to the 200-day moving average, which, you know, it looks like what I've drawn in is really just kind of rangy in here. But I think if you're a trader of the staples, they're apt to say, well, this still looks favorable because we've got a pullback to the 200-day moving average, which was tested and held for about a week. Now we're moving our way through what was potential resistance here. And if we're going to do that, and many would expect that you're going to start to see this trend from this point on, meaning get out of our consolidation window and start trending against a speedier moving average. So that certainly could play out in some of these other spaces. And reminder, yes, the market is going to be a lot of red for us across the board in many cases here today. But I think the reminder is as we often say, there's a bull market somewhere all the time. Our job is just to find it. If you want to be a bullish trader, you just got to find the bullish opportunities. Not everybody's going to look at the market the way it is right now and suggest that they want to be trading the bearish side. It's hard for many of us to shift that mindset, moving from being a bullish trader to being a bearish trader. So in a lot of cases, traders just look for where the bullish opportunities reside. So that might be one way to give thought to it. Yeah, you know what, Carol? I don't have a good way of going about buyers versus sellers, and other than say put call ratios, keeping an eye on how those might be playing out. For example, looking at the puts and calls side by side at the money. I think a lot of traders would do that with something just like the S&P 500. You know, so if we were to, for example, look at The break point here, right around, we're at 54.70. So if we were just looking at the 54.70s today, let's use tomorrow's expiration, not today's. And again, I know options aren't for everybody, and very infrequently do we talk about them here. But I just wanted to present this as a talking point merely. So, reminder: we know that options are not appropriate for all investors. They do require a prior approval to trade them. You need to be familiar with the risks and disclosure statements that are available to you. What I'm seeing here, everybody, let's, instead of, do I have volume in here? It doesn't look like I've got volume here. Let's go to my default, which incorporates. So this is one of the things I've done is to create, instead of relying on the breakdowns up here, I customized my columns and created a Kevin's default. And that's why I've got the theoretical pricing model in here. I've also got volume and open interest, a couple of the basic Greeks with it. And when I was looking at here for tomorrow's date at this current strike, 54.70, it seems like the heavy volume, I mean, and again, a couple hundred contracts isn't necessarily heavy volume, but just take a peek at what we're seeing here, everybody. 3,800 on these 54.50s, 2,000 on these 5500s. Again, round figures, that makes some sense, right? But additionally, look at the call side. Look at the number of contracts on the call side compared to contracts traded on the put side. It is obvious at this point, regardless of strike, that you're seeing far more interest on the bearish put side as it relates to SPX options. So that can be a little anecdotal, but I think many traders would look at the breakdown right here and say, all right, that stands to reason. Now, when you're looking at 5,500, notice I just said 700 was the volume. That just increased 700 contracts. That could be notable at the 5,500 strike for tomorrow. So, somebody out there having a belief that there could be the opportunity for a bit of a rally in the short run, and certainly could be the case. We'll have to see how that plays out. Let's look at some of those other important areas that many of you are asking about. Some questions about the dollar. So let's look at the DXY for that. Dollar just getting hammered. Again, this is not a surprise. This is all tied to the economic view of things, and the dollar going lower in general terms, as we often speak, is not a negative per se, but this speaks so much to the concerns on the economic front. Okay, so that's why you're seeing this drop dramatically. Now, questions about why we're seeing precious metals drop. Just yesterday, we talked about the look in gold. We get that symbol proper, and maybe then we'll see a chart here, everybody. So you're getting a little bit of selling in gold today. So why? I don't have a good answer for this one, everybody. If I was to take a bit of a guess at it, it might simply be some profit taking after an enormous run. And it might just be taking that opportunity off the table or allowing gold to pull back to a level where we could easily see more come in. But I think many traders would tell you that the rally we've seen in gold, as good as it's been, it may not have run its course given today's selling even still. I think it certainly bears watching. Maybe keeping an eye on that 50-day moving average in purple. You'll notice that the 50-day moving average is now almost caught up with the former horizontal resistance, which many traders might tell you is potentially now horizontal support. And that was this period right in here. We went sideways for about a week, pulled back, broke out, and kept on going. Got a nice little bull flag, and now you're getting that little bit more profit taking today. And I say profit taking today because look at the difference between this, which really wasn't profit taking. This was just consolidation, right? Just building out the cloth portion of our bull flag there, and then resolving bullishly. A candle like today's kind of gives the impression of a little bit more profit taking than anything else, I might suggest. So that's kind of the thought as it relates to gold. I wonder if silver is making a similar pullback. Sure is. Interesting. It found the trend line that I've got in there. So maybe for those waiting on an opportunity, this could be one of those spots. You could be looking at the 200-day moving average. It's not too far down here. So the difference between entry right now and the 200-day is only $1. And so the trader who might say, I like proper risk versus reward, could mean that they're looking at an opportunity for exposure to silver. Is it notable that we've got a little bit of a double top up here? Yeah, it's a heads up. A lot of traders will make note of that. But in order for that to look as though it's an actual head and shoulder top or double top, pardon me, everybody, we probably got to trade through the low we made back here. Okay, so I could put another line down there for us, and I think that becomes an important spot. So, under 29, things change on silver perhaps, but we'll see. Obviously, the trend line is there first. So we'll see if this plays out kind of like it has been playing out, right? What about Bitcoin? We'll take a look there. The risk off conversation really hitting Bitcoin as well. We've been previously noted the breakdown from what some called a bit of a head and shoulder top and our inability to maintain our investment over the 20-day moving average. Well, we're right back below it. We had that huge reversal yesterday at an area of resistance right there, right? So I'd prefer that to be a line. So that's notable for many traders. And again, we are just in price discovery mode for a lot of traders, everyone. That 200-day moving average is still important. And I think given what we've seen out of this, we're still trying to figure it out with Bitcoin, right? So given the enthusiasm that I have a feeling will constantly be around as it relates to Bitcoin, it seems, you may expect bounces to be opportunistic, but got to set those levels, got to know where you want to move on, everybody. Okay, so what did I see this morning on jobless claims? I did see something on that, so let's grab the data there. Liz Ann was talking about that this morning, and I just wanted to make sure. Yeah, job cuts are up. Job cut announcements are up over 200% on a year-over-year basis. That's not great, totaling 275,000 jobs in March. That's the highest level we have seen since May of 2020, everybody. So pay attention to that. The job situation, it is certainly slowing. I think there's been some expectation of that, but to see that coming out in the form of the initial jobless claims, not ideal. So keep that in mind as well. Let's see what else you guys want to be hearing. Oh, well, yeah, we could look at, I know a lot of, I know JB, James Boyd, likes to keep a close eye on what's going on with the yen. Looks like the yen has broken out there, everybody. Had been, kind of hanging out, had a little pullback, and now this candle to the upside looks like pressure on the U.S. market. So there certainly has been of late a bit more correlation there. And today's move, I got to say, is not terribly surprising. If you guys are all attending JB's classes, how great he is. So he's been talking about the move in the yen here as well. Yeah, you know what, Greg, a couple things. They appreciate the thought. Believe it or not, Liz Ann does have a segment on here periodically. There is Mondays in the afternoon. We also on Mondays, we get Jeffrey Kleintop here, Schwab's chief global investment strategist, along with Kathy Jones, our fixed income strategist, and Liz Ann having her Liz Ann Live segments typically on Monday afternoons when we're in schedule at least. And she's fantastic, of course. You're going to find her everywhere today. Take your pick of your favorite financial network. You're going to find her out and about for many an interview today. Okay, we've only got about 5 to 6 minutes left, everybody. I know we've only hit on a few of these sectors. Let's just quickly move through. Energy getting beaten back here. Can't say we're surprised. We've got this big move back below all major indices. Remember, we talked about the importance of this level with I say indices. What I meant to say is moving averages. I'm sorry. The 20, the 50, the 200, energy below all three. Again, this likely speaking to just economic health here, of course. So let's see here. Materials. Materials going to try and hold up, but you're getting a little bit of selling here. Industrials taking it on the chin. We're down about 3.5%. There's a line of potential support, sitting basically at the lows we've made over the last month, but dubious as to whether that's going to be maintained. Discretionary certainly getting pounded here, unfortunately, back to lows we just saw about 2 weeks ago. Could that be a bounce zone? Sure. Could we move through this with gusto? Absolutely. Be disciplined, everybody. Set your levels. Healthcare, like I said, a little bit of an outperformance from a relative strength standpoint, but a chart that just doesn't necessarily look fantastic, does it? We are below all three moving averages there again. So again, as defensive as some may want to be and willing to be in healthcare as one of those defensives, you'd love to think that that's going to be a safe haven. The chart isn't necessarily telling us that immediately. So maybe just a little bit of caution as it relates to this. Yeah, I think that makes some sense here. I'd love to see this hold up, but yeah, a little bit uncertain with some of these. And again, this could just be one of those deals where we need a couple of days to figure it out, right? Where are we going to deploy funds? Financials pulling back. Now we remain kind of range bound in here, everybody. And in truth, I think many a trader would tell you holding on to the 200-day moving average still tells us there's opportunity here. This is a pretty strong uptrend working from that October bottom. And we've really just gone nowhere in financials now since November, right? Basically sideways. So it's an interesting look, but again, where the levels appear to be obvious, right? Where you might start to take note. Now, yeah, trade and grow, is that possibly a divergence? Well, some would say if you're looking at a period like this and we are in the midst of falling, the thing we want to see is price action stop falling first, right? We got to get that to stop. And then we will know if what we have is a potential divergence or not. So right now with the financials, if we get down to the 200-day moving average in my green line and we start to see a hold of that level, right? Couple of days testing the 200-day, testing 782, but holding on, and the RSI is above and still maintains the current level, for example, well, that would be instructive. The challenge here, I think, is that we are apt to continue to slip towards that 200-day moving average, and then that intraday weakness and weak open followed by a weaker close is apt to bring the RSI even lower, which, when the selling abates means we could very easily just be at the same RSI level and essentially just not giving us any divergence. You know what I mean? So kind of keep that in mind as well. Okay, let's see. I guess we could look at tech. You're not going to find a whole lot of enthusiasm here, everybody. There's new lows in the RSI. Selling has increased. Notice the amount of volume in the selling down here. Let me highlight that. Look at all this volume. Just the raw volume. You can see the increase here. Even when we were rallying in the middle off of our August 5 bottom, all of these spikes were. This was all well and good, but your average was essentially right through here. These are like the upside level of volume, right through here. But look at how much more volume we are seeing in the last month and a half here. And that volume is telling you quite a bit. There's been quite a lot of unloading of the space here. So just a lack of comfort as it relates to high growth names. And that's not really a shock, honestly. So yeah, why do we traders get defensive in times of uncertainty? Well, you got to maintain your capital if you want to be a trader. And capital preservation is absolutely part of the process. We talk so much about trade management in this segment, but if you don't have the capital with which to work, then you don't have the opportunity to trade. So that's why it's so important to mitigate your risk, maintain the cash when you have the opportunity, take advantage of your opportunities to build that cash. Again, I recognize today is not likely to be a fun day, but Don't necessarily allow it to drive your emotions today, everybody. Last thing we're going to look at is that VIX one more time. Let's just take a peek. See it pushing over 27 towards 28. Keeping an eye on the VIX today could be instructive for us. So maybe a couple of charts side by side, the VIX and the SPX, for example, can give you a little bit more clarity. And do expect them to move in tandem. But I think the takeaway here this morning is that first hour has been no reprieve, everybody. There's your S&P at lows. There's your NASDAQ 100 at lows. Your Russell 2000 at lows. Your semis at lows. Takeaway, rough day, okay? Now, doesn't mean we got to do anything at all. So my hope is that if nothing else, you can keep it tuned right here. You're going to get more content from us for the remainder of the day. At this point, that's about all I can offer, right? My hope is that you find a way to make today an interesting one, perhaps a learning day for us across the board. But I do appreciate you all joining us. Keep it tuned to the Schwab Coaching channel. Like I said, much more content here live today from us. Follow Barb and me on X, Kevin Horner CS, Barb Armstrong CS. And if you liked today's conversation, hit that thumbs up button down below for me. We're going to get this one into the archives for all of you. And that would help us out in the replay. So with that, I'll thank you all for joining. Big thanks to Barb in chat, and a thanks to all of you. I hope you all have a great Thursday, and I look forward to seeing you again real soon.